In today's episode, I'm going to walk you through the 7 best strategies to lower your taxes in retirement. These are strategies that I personally have used over the last several years to help dozens of clients potentially save thousands of dollars on their taxes in retirement if they follow these 7 steps properly. I use these strategies on a daily basis, and they can result in potentially thousands of dollars in tax savings for you. You see, the problem is that most people simply haven't been educated on these strategies, and more importantly, they have no idea how to implement them even if they have been educated. The right information is simply hard to come by, and it usually costs thousands of dollars to obtain, or it's only available to the ultra wealthy. But in today's episode, I'm going to share with you these strategies and show you how you can implement them immediately. This is the Money Mastery Unleashed podcast, and I'm Adam Olson. I've been a financial advisor for over a decade, and I've helped hundreds of clients use these strategies to pay less on their taxes in retirement. Let's start with number 1. The first thing that you need to do to save on your taxes in retirement is to contribute to Roth IRA accounts and your Roth 401k. You see, the way Roth accounts work is you get no tax break today on your contributions, but as they grow, there's no taxes due, and you get to take the money out tax-free in your retirement. Now, in order to contribute to a Roth 401k, you have to have access to that at work. You can put in $23,000 here in 2024. In addition to that, if you're over the age of 50, you can put in another $3,500 into that Roth 401k. Now, if you want to contribute to a Roth IRA, you need to be careful and keep an eye on your income, because there are income limits that if you make over a certain amount, you cannot contribute directly to a Roth IRA. Now, that Roth IRA allows you to put in $7,000 in 2024. In addition, if you're over 50, you can put in another $1,000. So if your income is, say, $280,000, $350,000 as a married filing jointly couple, you might have to implement a backdoor Roth IRA strategy. Now, I don't have time to go through that in this video today, but you should work with a trusted advisor that you have to implement that backdoor Roth IRA strategy if your income is too high. Now, let's move on to number 2 here. Number 2 is to take Roth matching contributions from your employer plan. You see, there were some legislative changes here that allow Roth matching contributions to be able to be given inside of your retirement plan at work from your employer. So what does that mean? Well, let's say you're getting a 3% or a 4% match in your 401k plan at work. If you elect Roth matching contributions, the employer will put in Roth dollars for you. Now, you'll be taxed today on that contribution, but just like the Roth IRA and 401k contributions, the match grows income tax-free, and you take the money out income tax-free in retirement. So number 1, Roth IRA, Roth 401k. Number 2, take advantage of the Roth Match if your employer offers it. This legislation is pretty new and it's just coming out, so be on the lookout for this in the next 2 to 3 years rolling out inside of your employer plans. Number 3, don't miss this one. It's very important. Contribute to your HSA at work if you're eligible for one, or if you have an individual HSA eligible plan, contribute to that as well. You see, HSA plans are triple tax benefits. This is one of the little known secrets that you need to be taking advantage of. HSA dollars go in pre-tax. They can grow tax-free, and as long as you take them out for qualified medical expenses or qualified distributions, you pay no tax on that money going out. So HSA is an excellent tool for you to be utilizing to allow you to get tax-free income if you use it for the right things in retirement. And it's the only tool that's out there that allows you to put pre-tax dollars in and take them tax-free out if you're using them for the right thing. So don't neglect that HSA if you have access to it. That was number 3. Number 4, you need to think about Roth conversions. So what is a Roth conversion? Simply put, a Roth conversion is moving money from a pre-tax account to a post-tax account. Now, you pay taxes when you utilize this strategy, but if implemented properly over the next 2024 tax year at 25, all the way up to 2030, this Roth conversion strategy could potentially save you thousands of dollars in taxes at retirement time. You see, it's a general consensus among the country's leading tax experts that taxes are going to increase in the future. And if you want to take advantage of current tax codes, you can move money from pre-tax to post-tax. Raise your hand today and say, I want to pay these taxes today, knowing that that money is going to be tax-free in the future. So do not neglect that Roth conversion strategy. Remember, you can implement this with IRA plans. In addition to that, you can also implement it with some 401k plans if they have a conversion strategy built into the 401k plan. talk to your employer about that strategy if you want to implement that inside of your workplace plan. Let's move on to number 5. Number 5 is the life insurance retirement plan. I just did a powerful episode with David McKnight, the author of Power of Zero. So if you want to dig into this more, check out that episode as well. Essentially what a life insurance retirement plan is if you structure it properly, it allows you to put money into a life insurance contract, and then you can utilize that money at retirement time for tax-free income as long as you stay within the guidelines of the policy and the way it was designed, and you keep within the boundaries of what the IRS allows you to put in the life insurance policy. You see, a life insurance retirement plan, it's also a diversification tool for your retirement income. So not only does it allow for tax-free income at retirement time, but it gives you a death benefit when you're young and you need it, or it allows you to possibly use that money for the nursing home if you need that in retirement time as well. And then what we really love about it is the ability to take out tax-free distributions or loans from the life insurance plan to get you some more tax-free income at retirement time. Number 6, this is one that you may overlook and I don't want you to forget about it. Think about how you can strategically claim your Social Security benefit. Now, I don't want to get into it too deep in the weeds here, but if you accelerate your Social Security benefit before your full retirement age, you get less of a lifetime benefit. If you delay it past your full retirement age, you get a higher benefit, and it increases about 8% per year every year you wait past your full retirement age. So why is this important? Well, if you can strategically claim your Social Security benefit and then time it with distributions from your retirement portfolios, you could possibly lower your tax burdens in the year that you don't take your Social Security benefit and allow your Social Security benefit, if delayed, to be at a 0% tax rate in the future if you implement some of these strategies that I've been talking about with you today. So don't neglect delaying that Social Security benefit and strategically claiming it at a point in time where it's a tax benefit to you. Now, number 7, this is an important one that I want you to think about. Qualified charitable distributions. You see, if you have pre-tax IRA accounts, which is totally fine, at age 70 and a half, you can elect to send some of your money from your pre-tax IRA account to the church, charity, or nonprofit of your choice. Now, you don't have any taxes due on this distribution, and you simply give the money to the charity, they can cash the check, and they can use it with no taxes due. So don't forget about that qualified charitable distribution that you can utilize at age 70 and a half to give some money to the church, the charity of your choosing. That's a very important one. Now, its partner here is the qualified longevity annuity contract. You see, at age 73, your pre-tax accounts require you to start taking out some money. Okay, so the partner to the qualified charitable distribution is called a qualified longevity annuity contract. Now, these are two separate complete things. So what a qualified longevity annuity contract, it allows you to shift some money into an annuity contract that you can turn on income from in the future. But what that allows you to do is every dollar that you shift in the qualified longevity annuity contract is a dollar less that's used for your required minimum distribution calculation. You see, a lot of people get caught in the trap of pre-tax their entire life. And they have this big pot of pre-tax dollars, and all of a sudden at age 73, they have to turn on these dollars. And when they turn on these dollars, they start paying a lot higher income taxes because their income's higher. Well, these are two things that you can use to lower that burden: the qualified charitable distribution and the qualified longevity annuity contract. And these are the 7 best strategies that I just gave you to lower your taxes at retirement time. You now have everything that you need to go out there and use these strategies in your retirement to lower your tax rate at retirement time. However, I understand that it may be complicated and confusing, all these 7 things that I just went through with you. So if you want to work with an advisor, I would encourage you to click the link in the description of the video, and you can set up a free meeting with me or another advisor on our team, and we will help you develop the ideal retirement plan for you in your specific situation. And I look forward to seeing you on the next video. And if you need help above and beyond that, I'd encourage you to visit my website or check out some other videos inside of my feed here for more information on developing your ideal retirement plan. This podcast is for educational purposes only and may include references to concepts that have legal and or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA, SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services.